Hey guys, what's up? It's AB Trades here. We're going to be going over in this video how to swing trade. This is not a topic that I cover a lot. However, it is a topic that has been requested recently. All those of y'all who are working, have full-time jobs, have things that are happening throughout the day, swing trading will be your next best bet. However, you can also make just as much money swing trading options because options deliver great returns. Alright guys, if you've never been to my channel, I'm AB Trades, and I teach people how to day trade options. Please go through my YouTube channel. Please hit subscribe because I know you'll like the content. Turn on those alert notifications, and most importantly, put that thumbs up so that I can know that you like the video, or thumbs down if you didn't. Engagement is good for the YouTube algorithm. Alright, moving on back into the topic of this video, swing trading. So, swing trading, I have two approaches, two strategies to help you swing trade. The first one is the 15-minute Heikin-Ashi and moving average strategy. So I want to show you completely here how to set it up. So we're going to go to the 15-minute chart, which is each candle represents 15 minutes. We're going to go into the style of the candles. We're going to go into this and we're going to type in Heikin-Ashi. Heikin-Ashi is a trend following candle setup. It's not going to look exactly like it did on normal candles, but that's because it shows the direction of the trend. The longer the candle, the stronger the trend. When the candles are getting smaller, the trend is getting weaker and more likely to reverse. So it's not going to be set up the exact same way as you see normal candles, but it helps you see the trend. When you're swing trading, you want to find the trend and trade the trend. So in conjunction with this, we're also going to be pulling up a moving average. So you can use whatever moving average you would like. There's simple moving average, there's a whole moving average, and there's everything. So you can either get a moving exponential or an exponential moving average, EMA, and I would set that to 20. Or one of the ones that isn't talked about a lot, but I found is really useful, is the whole moving average. We're actually going to use the whole moving average. So if you can see here, oops, my bad, I forgot that we were going to put the whole moving average on 50. So the whole moving average was created by a guy named Hull, surprise, to have a moving average indicator that is not as laggy. So what you can see here is when we're facing a trend, we're looking for it to hold below this moving average, with the candles also being red, showing that it's in a downtrend, right? So if you can see here, we're breaking down, for example, on this day that we had the huge sell-off, we were breaking down, we're under the whole moving average, the 50 period. We're having red candles, and we hold it all the way until it closes back above. That would have been a great swing trade. Now, after I discuss the second option strategy, after I explain this one a bit more, I'm going to show you all exactly which options to buy so you're not losing money on theta. Alright, so if you can see here on this green day, we were holding above it. We had a huge green candle, it stayed green, whatever, all the way up through this. Stayed red all the way down through this. Red, green. The swing trading may last you a day, maybe a week. In this market, in the range bound, you're going to get one move a day, or maybe even two. For instance, this was one move a day, bounced off the trend line, and went on a second move on that day. But you can see here, it shows the nice trend for the day. You can also use this in conjunction with day trading. Give you an idea of the trend for the day. So that's how you use that setup. Now I'm going to go back, and I'm going to move back to normal charts so that I can show you all the second strategy. So removing this, we're going to go in and we're going to do the second strategy, which is RSI divergence. So we're going to add RSI to our chart, and we're going to get started here. So RSI divergence is by linking two highs and two lows and watch for a diverging RSI. So if you can see here, let's see if we can find a great example. One I think would be, it's very hard to spot these, but one would be right here. You can see that let me zoom in a bit more. You can see that the high of this candle is lower than the high of this candle. So this is forming an upslope here, right? Because this is lower, this is higher, we're forming an upslope. But while this is forming an upslope, this is forming a downslope. That's where it gets the name RSI divergence. Or you can even put it on the top, RSI divergence. So that's going to be an example of diverging to the downside. There's not really too many good examples I'm seeing here just because of this range-bound market. But usually you tend to get that range-bound. Like if you can see here, this is pointing down. If you can see the RSI is starting to curl up. So this is divergence of the RSI, which leads to that nice move in the opposite direction. So RSI divergence is a trend reversal pattern, while what the Heikin Ashi and whole moving average is more of a trend trading pattern. So now we're going to talk about what options do we need to trade. So if you want to stay away of theta, or if you want to make sure you're not being affected by theta, which is the price that your options are decreasing by as time goes on, and since you're going to be holding these options for a bit of time, you want to make sure you're not limited by that. You want to go out to the next month or maybe even that next week. But again, the further you go out, the less profit you make, but also the less risk you are opening yourself up to. So the closer you go in, the more your profit will be, but the more volatile the option price will be, so you'll also risk more. But if we go in here, if we're swing trading for about 2 days, 6 days out or 3 days out, I would say more like 6. 6 days out would be perfect. So you're going to go here to 6 days out. We're going to extend it to all, and then we're going to put in here something that we don't talk about a lot. It's delta. So we're going to come here. We're going to see option Greeks. We're going to go here to delta. So when you're looking at this, you want to get a delta that is closest to 0.7. So if you can see here, the closest to 0.7 is right here. Again, that's pretty expensive, so you may want to go closer in. But the reason why I'm saying stay with a delta around 70 is because when the delta is around 70, you're not going to be seeing the move in prices. For instance, if those who day trade options would know that when you buy a call, the stock may go up, so the call price increases. Then you'll see a dip in the stock price, and when it dips, the call option will go all the way back down to the original price, even though the stock did not go down that far. It's because of the volatility in the market. When you have a 0.7 delta, it's moving just like the stock would move. So when it gets that pullback before it moves, the option price only pulls back as much as the stock. It's not coming all the way down in value. You're retaining the value in the options. Again, I know that's hard to explain, but you want to stay near a 0.7 delta. So if you even want to come up closer, let's say 3 days, you can even come up here to a 0.7 delta around here, and you're still looking at about $4 because, again, it retains the value. So again, guys, this is how you swing trade. You can use whatever options you want. That's just my advice. But those are 2 solid strategies to swing trading and making a lot of money, even though you're still working. All right, guys, thank you so much for watching. Please like, comment, and subscribe. We'll get a market update video tomorrow.